To bring about change, you must not be afraid to take the first step. We will fail when we fail to try. Stakes. If inflation continues accelerating while real wages stagnate, you risk watching your purchasing power erode month after month. If U.S. debt keeps expanding and the dollar weakens, you risk holding cash that buys less every year. And if silver loses this major support level, you risk sitting through a sharp liquidation that tests your conviction and possibly your portfolio. But the opposite is also true. If this level holds and demand surges, you risk missing a breakout that could reprice silver quickly. That's the tension right now. You, as a silver holder or potential buyer, are standing at a fork in the road. Either this is a structural base before a powerful move higher, or it's the last stop before a flush that shakes out weak hands. The cost of being unprepared is high on both sides. Background context. Let's simplify what's going on. Silver is trading near a long-term technical support zone that has acted as a floor multiple times in the past. Each time price dropped into this region, buyers stepped in. Not randomly, structurally. That tells us large participants consider this area value. At the same time, inflation data has been coming in hotter than expected. Consumer prices are sticky. Energy costs remain volatile. Housing remains elevated. Meanwhile, the U.S. national debt has crossed levels that were once considered unimaginable, forcing more Treasury issuance into an already fragile bond market. Think of silver like a spring, being compressed between two forces. On one side, you have macro instability, currency debasement, and rising geopolitical risk. On the other side, you have tightening liquidity, stronger short-term dollar moves, and speculative positioning in futures markets. Add to that the dual nature of silver. It is both a monetary metal and an industrial input. When global manufacturing slows, industrial demand weakens. But when monetary fear rises, investment demand increases. Silver lives at the intersection of these forces, which is why it can move so explosively. But here's what nobody is talking about. The real battle isn't just happening on the price chart. It's happening underneath the surface, inside the futures market, inside COMEX inventories, and inside the bond market. The support level you see on your screen is only the symptom. The cause is deeper. And that's where we need to look next. Deep analysis. First, let's talk about inflation and real yields. The problem is not just rising prices. It's the relationship between inflation and bond yields. When inflation runs hotter than nominal yields, real yields turn negative. Negative real yields historically support precious metals because holding cash or bonds guarantees a loss in purchasing power. Why this matters is simple. If the Federal Reserve struggles to contain inflation without breaking something in the economy, real yields can fall again. When that happens, capital looks for protection. Silver becomes attractive as an inflation hedge. But supporting evidence is mixed. Bond yields have been volatile. The dollar has shown strength in short bursts. If yields spike higher while inflation expectations cool, silver can struggle. That's the push and pull at this support zone. Second, let's examine COMEX and the paper versus physical market. The problem here is leverage. Futures markets allow massive paper exposure relative to actual physical supply. When speculative traders unwind positions, price can drop fast even if physical demand remains strong. Why it matters is because if silver breaks support due to paper selling, it may not reflect true supply and demand fundamentals. Watch COMEX registered inventories. If inventories keep shrinking while price tests support, that's a divergence. That suggests strong physical offtake beneath the surface. Supporting evidence has shown periods where physical premiums rise even when spot price dips. That tells you real buyers are active. If we see volume spikes on up days while inventories decline, that's constructive. If instead inventories rise and open interest expands during a breakdown, that's liquidation pressure. Third, we need to talk about industrial demand and geopolitical risk. Silver is used in solar panels, electronics, and advanced technologies. If global growth slows sharply, industrial demand can soften. That creates headwinds. But geopolitical tensions, trade fragmentation, and supply chain disruptions can tighten supply unexpectedly. The problem is uncertainty. Manufacturing data has been uneven. Energy markets remain sensitive to global conflict. Why it matters is because silver reacts to both fear and growth. If we enter a stagflation environment, weak growth plus high inflation, silver's monetary demand can outweigh industrial softness. Supporting evidence comes from previous cycles where macro instability drove capital into tangible assets. During periods of currency debasement fears, silver often outperforms because it is more volatile than gold. That volatility cuts both ways. But near major support, volatility can become opportunity. Climax. The real reason this matters is because support levels are psychological lines in the sand. They represent collective memory. Large funds, hedge funds, and institutional traders watch them closely. When price compresses at a major level during macro stress, positioning builds quietly. If silver holds and reverses with strong volume, it signals accumulation. That means larger players are defending the level. If it breaks with expanding volume and rising dollar strength, it signals forced liquidation. That means leveraged positions are being unwound. The aha moment is this. The level itself is not the story. The confirmation signals are. Volume behavior, dollar direction, bond yield shifts, inventory changes. Those are the tells. And if you train yourself to read them, you stop reacting emotionally and start responding strategically. Resolution and action steps. Now let's translate all of this into action you can take today. Step 1 is to monitor the US dollar index and the 10-year Treasury yield daily. If silver tests support while the dollar weakens and yields soften, that's constructive. If the dollar strengthens aggressively during a breakdown, be cautious. Correlations matter. Step 2 is to check COMEX silver inventory levels weekly. Watch the registered category. If inventories are falling while price stabilizes, that suggests physical demand underneath the paper volatility. That's a positive divergence. Step 3 is to scale into positions gradually instead of going all in at once. If you believe in silver long-term, consider allocating in tranches. For example, allocate a portion at current support, another portion only after confirmation of a reversal with strong volume, and hold some dry powder in case of a deeper flush. This reduces emotional stress and overexposure. Step 4 is to differentiate between physical and paper exposure. Physical coins and bars carry no counterparty risk, but have liquidity spreads. ETFs and futures offer liquidity, but carry market risk and volatility. Align your exposure with your risk tolerance. Step 5 is to define invalidation clearly. If support breaks decisively with heavy volume and macro conditions worsen, reassess. Protecting capital is as important as capturing upside. This approach turns uncertainty into structure. Instead of guessing, you respond to data. Instead of chasing, you plan. That's how you survive volatile markets. Here are the 3 key takeaways. First, silver is sitting on a major technical support during rising inflation and expanding debt. Second, the confirmation signals, volume, dollar movement, bond yields, and COMEX inventories matter more than the line itself. Third, scaling into positions with defined risk protects you from emotional mistakes. If you found this breakdown helpful, hit the like button so more investors see it. Share your view in the comments, base or breakdown, and subscribe if you want clear, data-driven analysis on silver and precious metals. The next move in silver could redefine this entire cycle. Don't wait for the headlines to tell you what already happened.